Barton, good to have you. What's going to be sort of front and center for you when you hear these numbers later today?
Okay, I'm first really interested in the parks recovery. The stocks are down 30%, but parks, the Disney kind of parks and experience segment is really going to be over half a segment profit this year. And the theme park business in the United States is coming back like gangbusters. I think blowing everyone away with how strong it is industry-wide. And I want to see Disney, the leader, share in that. So that's point number one. Point number two is obviously, what are they going to tell us about the Disney Plus subscribers? Are they going to do anything to shake off the concerns that people have that this is an unwinnable game, even for someone as strong and someone who's done as well as Disney? I expect them to have a pretty good answer there, but that's going to be crucial.
Yeah, I guess that's where we would focus, because it would seem even if they get very strong numbers out of parks, investors still want to know, as you point out, what those subscriber numbers look like, and then just the profitability. You mentioned you expect that they're going to do a pretty good job explaining that. What are you expecting?
Well, I'm expecting them to stick with their targets that they've articulated, their long-term sub-targets. I expect them to talk about a step up in content and that propelling better subscriber growth over the next couple of quarters than what we may see this quarter. So I expect them to stick to their story. I expect it to be consistent with what we've seen with some of the other media companies, which is Netflix hit a wall, but the media companies with their streaming services are not. So there does seem to be some separation. Disney also has already announced a plan to put advertising onto Disney Plus. I want to hear them talk about plans there, the rollout, and what that could do for the subscriber ramp and the profitability.
I want to get your thoughts on valuation. Stock's down 30% since the start of the year. And to your point, we did see that valuation increase in large part because of the streaming service and comparables to things like Netflix. But the fact that it does have so many other businesses that help to keep it afloat, the fact that it is moving forward with these plans for Disney Plus to continue to propel the path towards profitability there as well. Does this valuation make sense to you at these levels?
I think it's too cheap. I think the company, my numbers, is trading at a PE against this fiscal of around 23 times. But they're going to be growing EPS a lot. This is a very depressed number. We're still coming back in parks. The movies are coming back. They're doing great with movies. Those have been meaningful contributors in the past, and I think we'll see that again. I think DTC is in the investment stage right now, and I think that'll become a contributor over the next few years. So I think that this could be a 20% CAGR in EPS over many years that I think is very ownable, which is why we're recommending it and saying it should be $177 stock.
All right, but Barton, I'm curious as to what's going to be the catalyst to potentially get it moving towards that price target.
Yeah. Look, I think the catalyst is going to have to be execution in parks, execution in DTC. And then we're going to have to navigate what happens to the macro. Because I do think that people worry about recessions and the impacts on something like Disney theme parks. And, we don't see the consumer acting like he's in a recession right now. So there's this big disconnect between what the market's pricing in, which is Disney down 30%, a lot of that DTC, but some of that recession fears. And a consumer who's spending is doing things like parks really strongly. If there's any type of hint that we're not going to be entering a recession near term, if it feels like the consumer's okay, I think Disney's going to be a beneficiary of that.